Imagine watching the 1-hour chart of a major Forex pair as price starts aggressively climbing. The momentum is building, the candles are expanding, and your tension is rising. You glance down at your oscillator, and it crosses the positive 100 threshold. In your mind, that number means overbought. It means the asset is too expensive. So you hit the sell button, expecting a clean reversal. Instead, the market steps on the gas. Price ignores your entry completely and continues surging upward like a runaway freight train, crushing your stop loss. This happens because a generation of traders has been conditioned by older tools, like the Relative Strength Index, to view mathematical extremes as hard ceilings. We are taught to look for the exit right as the move is getting started. And when retail traders discover the Commodity Channel Index, or CCI, they routinely apply those exact same reversal assumptions to it. They see positive 100 as a signal to trade in the opposite direction. Using the CCI as a reversal indicator often leaves traders fighting a trend that hasn't even hit full speed yet. To capture the actual meat of a move, we have to look under the hood at the unique math that drives it. Standard oscillators use standard deviation, squaring the distance from average price. This squaring causes single outliers to disproportionately blow out the calculation, pinning the indicator flat. The CCI instead calculates mean absolute deviation, measuring the direct linear distance between price and its moving average. By measuring the distance directly, the CCI prevents a new spike from hijacking the entire calculation. Even massive outliers only move the needle in proportion to their actual distance from the mean, keeping the indicator focused on the broader price cycle. This linear approach acts like a high-performance suspension system, highly sensitive to cyclical velocity changes. It reacts to peaks without getting stuck on extreme outliers. That structural difference dictates how we use it. The CCI identifies the exact moment a new cycle accelerates, rather than just estimating when an old cycle is exhausted. Here's the CCI chart and its zero-line equator. Above zero is a bullish bias, below is bearish. This creates a trend rejection filter. If the CCI bounces off the zero line during a pullback, the average price held as support, and momentum is returning. But the real power of the CCI lies in the positive and negative 100 thresholds. Look at this breakout. When the CCI punches through positive 100, current price is significantly higher than the average, entering an acceleration zone. For the momentum accelerator entry, we buy this cross into the extreme zone and hold while it stays above positive 100. A reading above positive 100 confirms that the trend has shifted from a slow crawl into high-velocity acceleration. Entering a high-momentum trend is only the first step. Managing the trade requires a precise method for detecting when that momentum begins to fade. This chart models the primary danger zone. When the CCI surges past the positive 200 level, the market has gone parabolic. These extreme states are statistically prone to sharp mean reversions. At this level, you stop adding to the position. Instead, you protect your unrealized gains by pulling your trailing stop up tight behind the current price action. The trade is closed the moment the CCI drops back below the positive 100 line. While the broader trend might continue later, the high-velocity acceleration phase has ended. During these pullbacks, advanced traders watch for a specific secondary pattern to determine if the trend is entirely dead or just reloading: hidden divergence. Notice the relationship between these two panes. Up top, price forms a higher low, maintaining its structural uptrend. But down below, the CCI forms a lower low. The indicator has reset its momentum entirely, while price has barely yielded ground. Using positive 200 extremes to signal stop-loss tightening and hidden divergence to spot continuations allows you to lock in profits based on data rather than emotion. You no longer have to guess where a top might form. The math identifies the breakout, and you simply wait for the momentum to confirm the direction. You stop fighting the market's velocity and start using it. You align your capital with the strongest forces actively pushing the price. To help you apply these multi-time frame rules, we have mapped the exact logic in the FXNX CCI Momentum cheat sheet. Download the guide today, open an FXNX demo account, and put the 100-level breakout strategy to the test to see how true momentum acceleration works in practice.